Now to continue a look here at the big picture, Jay Hatfield, founder, CEO, portfolio manager, Infrastructure Capital Advisors. Jay, thanks for being with me. So we're looking at things in a macro way. What's your macro look and take as to what we're seeing here, particularly with that jobs print today, earnings we've been getting in, and everything else that we have to digest?
Thanks, Nicole, for having us on. Again, we agree with a lot of the points your prior guest made. Specifically, we think people have gotten way too bearish about what the Fed is going to do. They've forgotten that after Biden's appointees are nominated, 5 out of 7 permanent members of the FOMC are going to be nominated by Democrats and are generally way more dovish than Republican nominees. So we don't think, and even if that weren't the case, we don't think that Chairman Powell is interested in doing what he did in 2018, which is tightening too fast. Because keep in mind, monetary policy has a lag. And probably the most important point is that there's already been a huge tightening in financial conditions. 10-year mortgages went from all-time low of 280, they're almost 385. So the Fed's going to want to wait, if they're rational, to see what impact that has on the housing sector and whether that cools inflation off. So we think a lot of negative Fed has been priced in.
I think you make a great point, because there's a couple things to digest here, and that is that monetary policy, there is a lag, and we need to wait and see, right? It's not just rate hike and ta-da. I mean, right? And so when people start talking about 7 rate hikes, it seems a little outlandish at every single meeting, because it may not even be enough. It's too much, too fast, maybe, to see what happens. And then in which case, as you noted, back in 2018, when we got tightening too quickly, it really put the brakes on the market and the economy more so than they anticipated, to the lag point that you're making. That being said, to have a more dovish Fed will be interesting, I think. And as we look at what's going on going forward, this market, which has now really pulled back, right? You have a lot of tech names, for example, that are beaten down. We're down probably 10% in a lot of names. Are there opportunities, ways to make money?
Yeah, we think so. We think the key thing to focus on is liquidity and interest rates. But there is an urban myth that interest rates impact technology stocks more than regular stocks. Most stocks in the market have similar interest rate sensitivity. So it kind of makes sense with the big rise in interest rates of the market pullback. But we think the rotation, because of less liquidity from tech stocks to defensive dividend stocks, will continue. So we've been recommending since the end of last year defensive dividend stocks, which are working. Most of those stocks and the funds that we run are flat to slightly up for the year. So we think that trend will continue, where you'll get blow-ups from a lot of the overvalued tech stocks like Facebook that benefited from the pandemic, and then a rotation into more conservative stocks that benefit from the pandemic opening, like REITs, preferred stocks with low volatility, utilities. So those type of investments we think are the best place to be. And the great thing about those securities is even if you're wrong, you're right, because you get substantial yields, so you can afford to hold them over long periods. Whereas if you're Facebook and they continue to disappoint, you don't get any yield, and there's, trade at high multiples. So we like the defensive stocks for this year.
Right. I saw you had some dividend payers and pipelines and large cap energy, looking at sectors that will reward you along the way, telecom, utilities. I wanted to delve into your comments here on crypto. In fact, saying that as the Fed makes its moves, that really could put a damper on crypto investors, and that Bitcoin could end the year at below 20,000. Tell me about this, because people are celebrating that it hit 40,000 today.
Well, there's one key fact that people should focus on, which is in the United States, if you read Article 1 of the Constitution, it's not legal to create your own currency. Even states are prohibited from it. And if you listen to Chair Gensler of the SEC, he doesn't even call them coins, he calls them tokens. So you have a huge regulatory risk out there. But then probably more importantly, I think that what Bitcoin and crypto represents is an indicator of excess liquidity. So you hit 70,000, came into 35. I think that maybe there could be a rally in crypto for a while, but when the Fed's actually shrinking the balance sheet, I just can't believe that these prices will be maintained and that the continued decline in momentum stocks, meme stocks, and crypto will commence again when the balance sheet reduction starts.
Understood. As we have less money supply and that velocity to the downside, and you'll have rising rates, and just people will be more concerned. It'll be interesting to see how they behave and where they may reallocate their investment choices, right? And that's part of the big picture. You also talked about the energy environment and seeing oil here on the higher end. At this point, 80 to 100, and then beyond.
Well, the one thing that I agree with a lot of the comments from your prior guests, but the one thing that's really critical to keep in mind right now, so the supply and demand work we do indicated $80 to $100 oil, but we're only in the first month and we haven't even had any recovery in international travel, and we're at $90. It's important to recognize there's probably $5 to $10 of premium because of the potential attack of Ukraine and embargo against Russian oil exports.
Right.
So you have this digital outcome coming up, but we still, notwithstanding whether that actually happens or not, we're still bullish on oil because pandemic is waning. You're going to have recovery international travel. That's about 3% of global demand. So supply and demand fundamentals are great. And we've made a huge mistake, which is trying to phase out, not coal, we should need to get rid of coal, but increase natural gas production. And that's why you see an energy crisis in Europe, is they're ahead of the United States, and they foolishly phased out coal and natural gas too quickly. And so we think that creates a tremendous tailwind for the energy market, because to the extent natural gas prices go up 600%, that drives oil higher. That's the equivalent of almost $200 a barrel of oil in natural gas terms. So we think the fundamentals are very strong, but just beware that we have this digital outcome about Russia attacking Ukraine.
Yeah, Jay, I love talking with you. We really hit a lot of different topics, including areas to put your money to work this year. But I think you're right. I mean, the energy situation in Europe, too, the European energy transition is a tough one, and we'll see how the U.S. could potentially benefit from that, too. Jay Hatfield, wonderful to chat with you. Thank you so much, of Infrastructure Capital Advisors. Thank you, Jay.